silver is leaving COMEX. It's also I think we're at the lowest level in years. It's also leaving the LBMA. It's about half the level of about 4 years ago. And it's also leaving Shanghai, the silver exchange. Where's it going? Well, it's being consumed. And the reason it's being consumed is because the electronics industry is demanding more silver than it's ever demanded ever before. We've had a decade of rising silver demand, much of which is coming from the electronics industry. We've had a decade of falling silver mined production. 4 or 5 years ago, we went into a situation where we passed from surplus to deficit. The deficit every year now is growing larger and looks like it will continue to grow larger.
Silver inventories are rapidly declining across major global exchanges, including COMEX, London Bullion Market Association, LBMA, and the Shanghai Gold Exchange. According to market analyst Clive Thompson, stockpiles have fallen to multi-year lows, nearly half of what they were 4 years ago. The reason? Surging industrial demand. The electronics sector is consuming record amounts of silver for semiconductors, EVs, solar panels, and advanced circuitry. Meanwhile, undead global mine production has declined for nearly a decade, pushing the market from surplus into a deepening annual deficit. As consumption accelerates and supply tightens, silver's structural shortage is becoming one of the most significant trends in the commodities market today. Now, we present the clips from Clive Thompson's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
If you ignore the falling supplies on COMEX and LBMA and elsewhere, there's quite a lot of above-ground silver, but there's nowhere near as much as there used to be. It's getting less. And as it gets less, you need to offer those who hold that silver an incentive to unload it. And the incentive is a higher price. So everybody has their price. And, the surge in price we saw from, let's say, below $50 to over $100 at one point at the end of January was one of those surges which made an awful lot of people think, that's higher than the price I would have sold at. I'm out of here. So a certain amount of silver came and met the demand, but the evidence is that silver is which came out, is still being consumed because we're seeing the supplies at the various futures exchanges dropping. So that nothing has really changed relating to the fundamentals of silver. And I think that it's quite possible, and I'd say more likely than not, that silver will continue to see higher prices as the industrial users who are relatively price insensitive. You can't stop producing cars just because the price of silver's gone from $50 to $150. I mean, what is it, $80? But you're not going to say, I'm going to stop the production line while I wait for the silver price to come down. You're not going to do that. So the demand is relatively price insensitive. The supply is relatively insensitive to the price because most of the we've seen a higher silver price, but the mine production has still gone down. So what are we looking at? We're looking at silver, which is being mined as a byproduct mostly of other metals. The easy mining has mostly gone, which basically means that any increase in supply of silver is going to be from the mines is going to be very marginal, which means that deficit is going to continue growing, in my opinion. And growing deficit means that you've got to have a higher price to suck out the above ground silver. When something is rising in price, there's always going to be people who want to get in the news by making a projection which is away from the crowd. And he might be right, but we've seen. I don't think they still do it, but if we go back a long time ago, the Wall Street Journal every year would publish a list of 30 or 40 or 50 analysts on where they saw indices like the Dow Jones and the Nasdaq. And every year after the year had finished, I'd go and look at where the bulk of the analysts lay, and typically the market finished different from where the consensus was by about 30%. Well, I say often by more than 30%. In other words, if they thought it was going to be up 12%, then the market would be up 42%. If they thought it was going to be up 12%, the market could be down 20%. In other words, they were 30% away. So it's fun for analysts to put a number on the game, but sometimes they can be very, very wrong. If the guys say it could be $160 an ounce, well, I believe that's possible, but it might get. I can't exclude that it's not going to go to 300 or 500. That's possible too. Now, I'm not forecasting it. I don't forecast things like that, but if I was going to forecast a price, I'd try and stick quite close to where we are now. That's what the wise analysts do, but the ones who want to get in the news will go out on a limb and forecast a very high price. Now, I do think it makes sense that it would go higher, but how fast and how squeezed it gets, you just don't know, because things can play out in many different ways. I wouldn't want to be a short in silver right now. Let's put it that way. I think that would be a dangerous bet.
Silver markets are tightening despite remaining above ground supplies. Inventories at major hubs like COMEX and London Bullion Market Association continue to fall, signaling persistent structural deficits. As available, silver declines. Higher prices become necessary to incentivize holders to sell. Recent price spikes triggered temporary supply releases, yet ongoing drawdowns show industrial demand, especially from automotive, solar. Knox and electronics manufacturers remain strong and relatively price inelastic. Meanwhile, mine production is constrained because most silver is extracted as a byproduct of other metals, limiting rapid supply growth. With deficits widening and marginal new output, fundamentals suggest continued upward pressure. Tightening supply-demand dynamics make short positions in silver increasingly risky in today's commodities landscape. Let's get back to the interview.
If the demand for oil goes up, they could just pump at twice the speed. That's an easy thing. You can't dig the silver up at twice the speed. It doesn't, it doesn't work like that. You can only get out so many tons of silver per day or per week or whatever it is. So what it comes down to is the demand and the supply. Now, I believe that what happened towards the end of January was a lot of consumers of silver, factories and so forth, who are manufacturing solar panels or electronics or whatever else, they became quite nervous and decided to stock up on something a little bit more longer, a bit more silver than just-in-time silver. So a lot of them would have had relied on just-in-time supply chains, and then they're seeing and hearing the price of silver's going up, the silver supplies at COMEX are going down. What if we can't lay our hands on our traditional supply from our traditional source when the time comes? You know what? Let's buy a bit more just in case. And I think that was one of the things which probably accelerated the move upwards. And now we've had, as a result of that rise, this catastrophic fall for many, where we come down from nearly $130 to 65 at one point. Now we're around 80, I believe. 82 perhaps it is today. You'll know better than I, Elijah, because it's literally been very, very volatile all over the place. You blink and the price is $2 different from when you looked before, and it could be in either direction. So I think perhaps now it's come down. Many of the consumers of silver feel less concerned that COMEX I would say COMEX, less concerned that their traditional supplies of silver are going to dry up, because obviously some silver must have come out of the woodwork to drive the price down. The other comment I'd make is about the silver shorts. We've always had in the silver market the shorts. These are big bullion banks, and it's quite a legitimate play. Technically they're probably not uncovered because they got silver in place A, and they're doing the shorting on the futures exchange like COMEX. It's a nice, easy way to make money over and above your treasury return, because provided you've got the collateral to meet the minimum margin requirement, your collateral can be earning interest whilst at the same time you're selling a 3-month future, waiting for it to get a spot month, and the 3-month future is selling at almost always a higher price than the spot month. That's called the contango. So not only are you making it on your money market or your treasury bill that you've got as collateral, you're also making it by constantly rolling over these futures. And from an economic point of view, you probably feel you don't have any risk because you've got the silver stored in London. And again, that might be earning as well, because perhaps on your behalf, they're lending it out and earning a fee for you as well. So the amount by which these bullion banks can go short is unlimited. But of course, when the price starts rising, then they start to say, oh my God, can we get the silver from place A to place B? And we heard these stories about the smelters being backed up and unable to convert the London-sized bars into the 5,000 ounce bars needed in New York. And suddenly, although they're financially covered, they got the silver in place A and they need it in place B, converting to the right, moving from A to B and getting it to the right size bars is not as obvious not as delay free as they thought. So there was probably a little bit of panic amongst the silver shorts, many of whom were rushing to close their near-dated contracts, driving up the price as well. So it'll be interesting to know what's going on in May. Are there people who are now going long or short in May? First of all, are the longs expecting to take delivery because they're consumers and they're making sure they'll be able to get it? And the second question is, are the shorts going short because they think they'll be able to get that, lay their hands on silver before the time, or they actually believe that the longs aren't serious buyers? They believe that longs are just speculating too. We don't know the answers to any of these questions. We don't have that sort of insight. But what is perfectly obvious is there are immensely more open contracts at all times on COMEX than there is silver available to deliver. Many multiples of that. I haven't got the figure in my head, but it's probably more than a year's supply. I don't know where that silver would come from if people do want to deliver it, but in practice that's not what's being expected. People are expecting most of those contracts to, when they get to May, to roll over again. But it could surprise us.
Silver market volatility is intensifying as supply constraints collide with industrial demand. Unlike oil, silver production cannot simply double overnight. Output is limited, and most supply comes as a byproduct of other metals, restricting rapid expansion. Falling inventories at COMEX have fueled concerns among manufacturers, prompting many solar and electronics producers to shift from just-in-time sourcing to stockpiling. At the same time, bullion banks active in futures markets rely on contango strategies, rolling contracts while holding physical metal in London. However, logistical bottlenecks, such as refining large bars into 5,000-ounce deliverable units, have created delivery anxiety. With open interest vastly exceeding available silver, any surge in physical delivery demands could trigger further price shocks in this increasingly tight commodities market. Share your thoughts on his analysis in the comments section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.